Hello, everybody. Welcome to another week. Welcome to another podcast. Thank you so much for joining us. Impact Core Podcast. This week, a bit of a weird episode. I'm going to do sort of a movie synopsis. I know that sounds odd off the bat because why would I have an opinion about a movie? This one is finance related. And I have to say, finance related movies are typically pretty poor. I mean, no one is going to go out there and watch a movie related to finance like they are the Avengers necessarily. But there are some good finance related movies, lo and behold. The one that I watched a couple of weeks ago was Dumb Money, which was everything about the Reddit saga. Now, some of you would know about meme stocks, would know about the term diamond hands, would be sort of aware of the rally that we saw in the stock GameStop and a few others. And now we have a movie sort of talking specifically about the movie and the events. Dramatized exceptionally well. Really good cast, guys like Seth Rogen, the guy from Parks and Rec, whose name I always forget, who was also in the Last of Us series, and a few others like Shailene Woodley. So great cast, well written, really good movie. But the thing that got me thinking was, as much as they tried to cover a bunch of different concepts and topics and explain exactly what happened, you can't really do that in a movie that's supposed to be entertainment. So in a podcast that's more about finance education, I'm going to cover some of those points. I was watching the movie with my wife and my sister-in-law, and they had questions about sort of what exactly happened. Why is certain things happening? Can you explain certain topics? And I sat there going, well, the movie tries, can't do it completely, but if I can, then let's do a podcast about it. So I recommend watching the movie, whether you listen to this first or sort of watch the movies or sort of listen to the podcast after watching the movie. And hopefully some of these thoughts and comments would help. Even if you don't watch the movie, I'm sort of going to give a high-level summary of what went on. It's already happened, and I'm not really doing a spoiler alert thing here. But I think that some of the concepts that I'm going to discuss are actually quite interesting ones. It's stuff that flies slightly below the radar in terms of finance terminology. And therefore, if you know it, it sort of broadens out quite quickly what the world of finance is like, especially when it comes to things like hedge funds and shorting of stocks. Last week's episode about the S&P 500 versus the Dow Jones versus the NASDAQ. That was another classic example of something that flies just below the radar, just out of common knowledge. Once you understand it, though, it really enriches your knowledge when it comes to finance, whether it's in the media or just your general knowledge of finance. Okay, before we dive in, disclaimers out the way. Podcast is for educational and entertainment purposes. You should seek advice if you want to invest and you don't necessarily know how. This podcast does not constitute advice. And of course, I may hold stocks in a personal or private capacity, so be aware of that. Right up front, though, I held none of the meme stocks in a private or professional capacity, even though I thought the trend was interesting. You'll see why you had to be a little bit of a risk taker to invest in some of these stories. All right, so like I said, the movie was good. It references a time in investing that was a little bit weird because it was during the pandemic. And during the pandemic, there was a lot of oddity for a number of different markets and things. We were stuck at home, we were doing odd things, and we saw booms in certain sectors. Gaming, for example, sort of the engagement in gaming skyrocketed dramatically. We saw it in sort of trends and themes and with respect to shopping. So athleisure shopping spiked. The use of e-commerce spiked because we couldn't walk to our shops anymore. And there was a spike in investing during the pandemic. There are a few reasons why. I'll come to it in a second. You probably already know from a general knowledge perspective, but we will get there. In terms of what happened during the saga, if I speak specifically to GameStop, which is what the movie does, you effectively had this company that many people invested in. And when many people invest in something in the stock market, that price does rise. And that went against what the traditional knowledge was about this company. So a number of people were making tons of cash, but it seemed to go against the grain somewhat. Maybe I sound a bit cryptic with that statement, but we'll get into it. And let's start with, what on earth is GameStop? Now, if you're an offshore listener, you probably have an idea of what GameStop is. If you're a South African listener, maybe you're not aware, but it's kind of like a BT Games in South Africa, a store where you go in and buy games, but it has a unique footprint also where you can sell your old games, and you can also buy like secondhand games. Gaming aside, you could buy consoles, you could buy memorabilia, that sort of thing. Now, why it was important in the context of the world during the pandemic and just in general is because less and less people are buying games in a store. I did it almost 100% of the time. I am a gamer. I game less than I used to, but growing up, I gamed a lot. Bought all my games in store, reached a certain age, sort of end of school, going into university, where I would often trade in games, buy used games. So something like a BT Games or a GameStop was a place I visited every week, every 2 weeks, every month. Now, with the proliferation of the internet in South Africa, but also globally, I don't really do that anymore. I have a PlayStation 5, and it does have a CD drive, but I download every single one of my games. I also have an Asus ROG Ally, which is like a handheld console. Download all my games there online too. And of course, if you have a cell phone or an iPad, you probably do the same. So there was this structural change in the need for this company where, and I'm talking now about institutional investors, professional investors, sat back and went, hey, you know what? A company like GameStop shouldn't actually exist 10 years from now. And the thesis being we will download all of our games. So those people who used to walk into a GameStop every week or every month aren't going to do that anymore. And GameStop should disappear. Okay? So they almost want to do a negative investment on the stock, which is called shorting. And I'll get to an example of what shorting is, because most people don't understand the mechanism of shorting. But the idea is generally when we invest, we're buying into a stock and we want the stock price to increase. Okay. If you think practically, and if you don't understand shorting or don't have access to it, there's no way for you to actually have a negative bet on a stock. Apart from investing maybe in another stock. Say you've got Mr. Price and Truworths. Okay. That's here in South Africa. Offshore, we could go Zara, H&M. Right? You have two stocks. You think H&M's crappy for whatever reason. You want to invest in the competitor that's going to destroy them. So you invest in Zara or Mr. Price. Okay. It's still not a perfect negative bet because you're still betting on one of them to go up versus the other. But here we're talking about professional investors who took a negative bet, who benefited directly from GameStop share price going down. And that is shorting, and I'll get to exactly how it's done in practice a little bit just now. Okay, now the type of investors that are talked about in the movie and the type of investors who are often involved with shorting, and I'll explain why, are hedge funds. Now, hedge funds are almost like the most sophisticated investment vehicle that you can have. And it's differentiated from other investment vehicles. So I personally manage two portfolios inside an asset management company. One of them invests in global stocks. The other invests in local South African stocks. I am what's called a long-only investor, in the sense that all my investments are about buying companies and hoping that they go higher. I don't have any negative investment in stocks. I will not benefit if a stock goes lower, only if they go higher, which is important. Now, buying and going long are sort of used synonymously in this context. So I'm a buy investor, I'm a long-only investor. From a regulatory perspective, in most countries, including South Africa, if you are a long-only investor, you can't go short. Shorting has this connotation of leverage, and you'll see why when I get to the shorting example. That separates hedge fund managers from long-only managers. And my clients who invest in me are investing in a long-only vehicle, and therefore I will never short stocks, I will never take on leverage. I am not a hedge fund. People often get confused by the definition of hedge fund. That is the pure definition of hedge fund. Their ability to short stocks, their ability to take on leverage. What is leverage in this context? Well, let's assume I get a bunch of clients together and they give me $1 billion of assets to manage. I will take that $1 billion and I will invest it in $1 billion worth of stock. a number of different stocks across a portfolio. That is it. Leverage is this concept where clients might give me $1 billion worth of assets, and I might actually invest in $1.5 billion of assets. Clearly, I'm levered because the assets that I have is $1 billion, but I'm investing up to $1.5 billion. I've taken on $500 million of leverage. A long-only investor cannot do that. A long-only fund cannot do that. But a hedge fund manager can. Now, they have a bunch of other sophisticated tools and strategies that they can use, but the primary distinction is they can be levered. And you'll see how they lever via the example of shorting that I give you in a second. So the movie talks about hedge fund managers having shorted GameStop, and the reason why they don't talk about managers like me, fund managers like me shorting GameStop, is because we're not allowed to, quite frankly. You need to get regulatory approval to launch a hedge fund. We actually have hedge funds inside my business. And your investor has to be a sophisticated investor. So there's certain rules on how much an investor has to be able to invest in a hedge fund, or they have to be sort of qualified in terms of their knowledge around investments, etc. So it is a sophisticated vehicle, not meant for someone that is unaware or doesn't know what they're investing in, because of this idea of leverage. And you'll see why leverage is so dangerous a little bit just now. Okay, now, in the context of the movie, when we talk about sort of institutional investors, hedge fund managers, companies investing, they're sort of known as smart money, okay? And retail investors, so that's people like you and me outside of my profession, just investing on stocks in my private capacity, you doing exactly the same on things like easy equities or Robinhood, which is an important part of this movie. That's traditionally referred to as retail money, which is the opposite of institutional money. But there's also a phrase that is not polite for retail investors, which is dumb money. The idea that a retail investor doesn't know enough about the market to be able to beat an institutional investor who has access, who has information, who has money to buy research, etc. If you recall, and maybe you don't if you're young and too young, but back in the day, you had sort of stockbrokers cold calling people or cold calling investors and pitching ideas to them, because the internet wasn't really as sort of prolific as it is now. So you have a broker call you and go, hey, listen, there's this, and you'll see it in movies like The Wolf of Wall Street, if you watch that, another finance movie. Broker will call you up going, listen, I've got this stock idea for like this tiny little stock based in Nevada or something that does X, Y, and Z, and I think it's going to go to the moon effectively. It's going to skyrocket. You really need to get onto this theme. And maybe you do. Buy the stockbroker. Maybe it goes up, maybe it goes down. You refer to it as dumb money because, and you see it in The Wolf of Wall Street, sometimes these guys play you off against each other, sell you some crappy stock, are playing you against other retail investors or against their own book sometimes. So that's where this sort of term dumb money comes from. And in the movie, it's used ironically because in this case, spoiler alert, the dumb money actually takes out the smart money. And we'll talk about that in a second. Let's now talk about shorting of a stock, because many people, like I say, will use the term but not necessarily understand what's happening. So how do I take a sort of negative investment in a stock? How do I benefit if a stock price goes down? Well, it involves borrowing stock. Okay, so let's say I want to go short Disney. I'm worried about Disney Plus. I'm worried about Marvel and the Avengers. I'm worried about Lucasfilm and Star Wars and all of it, right? I don't think the parks are going to do well, etc. So I think Disney stock price is going to go down. And as a traditional long-only investor, there's nothing that I could do. The best I could do is not investing in Disney, okay? As a hedge fund investor, I have the ability to go short. So what do? I will borrow Disney stock from someone. Now, I'm not going to discuss the mechanism for borrowing. It is there and it is available and it is pretty smooth to do it. But I will borrow stock typically from another institutional investor. And once I've borrowed that stock, I will immediately sell that stock into the market. So in theory, I'm borrowing the stock. I now hold Disney stock and actually owe it to the person I borrowed it from. But I sell it immediately, right? Because I still owe the stock to someone, somewhere down the line, I have to buy this stock back to deliver it to the person that I sold it to. That is the loop. Now, how does shorting benefit me and how does it give me this exposure? Well, think about it. If I borrow the stock, and let's say Disney stock's trading at $100 to keep things simple, I sell it day one. Okay. Hopefully my investment thesis works out. Disney stock goes from $100 to $50. It goes lower. I then buy the stock back at $50 and then I deliver it to the person that I borrowed it from. Now remember, I borrowed the stock. I sold $100 worth of stock. That would have raised cash for me. I sold something for $100 and later down the line I'm buying it back for $50. You can see how I've benefited from Disney stock falling. And because stock is stock, I'll deliver those same Disney stock back to the person I borrowed it from. That is how shorting works. Borrowing the stock, selling it today. I often use an iPhone example in the context of this. We know for a fact iPhones come out every year. Say you know that the iPhone 16 is coming out and you want to benefit from shorting the iPhone 15. Well, you could borrow the iPhone 15 from someone, right? Sell it into the market today for however much an iPhone 15 goes for. And then say the day the iPhone 16 comes out, buy an iPhone 15 and deliver it to whoever you borrowed it from. And in theory, the price of the iPhone 15 should go down as time goes by. That's how shorting works. And that's how you take a negative investment. Now realize for a hedge fund, how leverage works is, let's say I've sold that $100 Disney stock today. While I'm waiting for the stock price to go down, I actually have this $100 available, right? I can take it and invest it in other stocks. I'm still on the line for the $50, but I'm still on the line for the $100, but I now have this $100 that I can invest in something else. So now while I'm waiting for Disney stock to go down and I'm waiting to buy it back, I can use the $100 to buy stock in Netflix maybe, because I think Netflix is going to do well. That's the leverage component. I've borrowed, I've sold it away. I'm supposed to keep that money to buy the Disney stock, but I'm buying another stock. So all of a sudden, I've sort of levered up my fund. That is the concept of leveraging that hedge funds use. And in that example, I've created something called a long-short fund. Some stocks I'm long, like Netflix. Some stocks I'm short, like Disney. And I've got leverage in the portfolio. And depending on how much I've borrowed and shorted, that'll determine how much leverage I have. And I can invest more than my investors have given me. And traditional long-only investment managers, in inverted commas, can't do that. We're not allowed to do that. I'm not allowed to do that in the funds that I manage. Okay. Why is shorting and the story around hedge funds so dangerous? Well, think about it from this perspective. As a long-only manager, let's assume I have a portfolio with only one stock in it. And let's assume that stock was Lehman Brothers, which doesn't exist anymore. Okay? Let's say I have $1 billion invested in Lehman Brothers and Lehman Brothers crashes and I get no money out of that bankruptcy. I would then lose $1 billion worth of assets. Okay? But realize that's all I can lose, the amount that I have invested. Shorting is a very different idea, because you're betting on the opposite. Now, Lehman Brothers stock can go from whatever it was to zero, and that's all the money that I lose. Remember, with shorting, you're betting on something going lower. Let's assume my thesis is that Disney is going to go lower from $100 per share. What if it doesn't? Realize that Disney stock, from a long-only perspective, can go from 100 to zero, and that's it. It can't go to negative 100, right? So the most I can lose is 100 per share. But in theory, Disney stock could go from 100 to anything, to infinity. Stock prices, there's no cap on stock prices. Now, I know we don't have a thesis for why Disney would trade at $1 million, but just by law of numbers, it can happen. Okay, that's the problem with shorting. Because if I've now sold the stock away and have to buy it back at some point, if Disney does rally significantly, I'm on the line. And if I can't afford to buy that Disney stock, because remember, as Disney stock goes higher away from what I bought it from, my liability becomes higher because, I have to buy the stock back to deliver it. We've seen hedge fund businesses get significantly, sort of build up significant losses by being short stocks inappropriately. And it can wipe out a business. I won't be wiped out necessarily by a stock going bankrupt. But if something rallies so hard, I can become bankrupt if I'm short, because I have to go back and buy the stock. And with leverage, I might not have enough money available to buy the stock again if it rallies really hard. That leads us directly into the next point of hedge fund managers went short GameStop because of the thesis that this thing wouldn't exist in 10 years' time. It seemed like a slam dunk. Okay. And it was picked up by a few places on the internet, specifically by a YouTuber/streamer named Roaring Kitty. And yes, the name is brilliant. And he put out this thesis that these companies that were short GameStop are not thinking it through. This company would exist. It would be smaller, but it would exist because there were a number of people who just didn't have internet access, who didn't have money to buy new games, who wanted to buy used games. There wasn't really a market for that. And his thesis was when GameStop was really cheap, that it was too cheap and that it would rally again. And this thesis was sort of picked up in a number of places, specifically on a forum called Wall Street Bets, which you may not have heard of, and sort of gained significant traction in terms of a number of people bought into the idea that GameStop wasn't dead. Now, crucially, there is a price for everything. If you walk past a car on the street that is broken, that cannot move, and if someone said to you, hey, if you give me 100 Rand, I'll transfer this car into your name. As much as it's a broken vehicle, it probably is worth more than 100 Rand or $100, whatever currency you want. It's probably worth more than that in just parts alone. Or if you put in the 100 Rand to buy the car, 1,000 Rand to fix it, and then sell it after the fact, could be worth 10,000 or 50,000 or 100,000 of some currency. The thing we often forget in finance is there is a price for everything. And if something reaches a price that is reasonable, almost regardless of what that investment is, it could hold value. GameStop, if it went low enough, could be worth something just based on the inventory that they have, which may not be worth sort of the price that's on the shelf, but it's worth something to someone somewhere. And there's this theory for Roaring Kitty and others that the price had just gotten way too low. So we had this movement now of people thinking, hey, the stock could go higher. But the secondary thing to his thesis, which is super important, is he understood that hedge fund managers were short, and he knew he could create something called a short squeeze if he gained enough traction in the stock. That was the second part to his thesis. What is a short squeeze? It's linked to the idea that if stock prices go up dramatically and there's enough people short, the liability that they have gets so large, the risk to their business becomes so large because of that infinity problem, that they'll have to buy the stock back at some point. And when they come back and buy the stock before their business fails, the stock price will go up quickly because of that buying at the back end, because of people being squeezed. We've seen countless examples of short squeezing in small scales often, but because people have been short and stock prices rally against them. What we saw in the GameStop story was ridiculous because the stock basically rallied thousands of percent to really squeeze hedge fund managers. Now, the movie goes into a number of interesting details around what Robinhood did and some of the hedge fund managers who sort of got involved in a couple of dodgy ways to stop trading on the stock, etc. But the idea is that via this short squeeze and via this sort of group buying of stock, GameStop did exceptionally well, and the dumb money seemed a lot smarter than the smart money, and a number of people made tons of cash during this trade. Okay, really, really cool idea. Now, this collective investing story, this diamond hands, HODL, which was the acronym for Hold On for Dear Lives, for Dear Life, is it a good investing philosophy? Kind of, yes and no. The way stock markets work, and if you think about stock markets in the old school where there was stock market floor, people would sort of put up a price for a stock. If enough people started buying the stock, whoever held the stock would just sort of incrementally raise the price, demand, supply, right? When all of these Reddit users, Wall Street Bet users, followers of Roaring Kitty started buying stock, the stock price went up dramatically because all these users were buying stock together and sort of demand outweighed supply and the stock price went higher. And the stock sort of rose astronomically. At the heights, the fundamental thesis that the company was now cheap, which was the original story, that story was gone. The price that the stock of GameStop was trading at was way higher than any fundamental story around people buying used games and this stock existing anymore, right? So the broken car on the side of the street was just way too expensive, but people were trading it up more and more and more. Okay, the short squeeze thesis around the hedge fund managers still exists, was still viable. That's fine. A lot of them were still short, even when the stock was at astronomical levels. So maybe there was a little bit of a spurt at the top that could have happened when these hedge fund managers came back into the market. But what's the problem with collective buying as an investment strategy once a stock goes past its fair value, its fairly reasonable price? It's that the last people investing in the stock, the ones paying the price that's not fair, the ones coming in last, they're kind of holding the bag when people start to disinvest. Because if you've held the stock all the way up to these heights, you're probably going to cash in at some point, right? The stock's above its fair value. And when the hedge fund managers come in, maybe they're the last ones buying, and maybe you want to sell to them. But all the people coming in late to the party are not going to get this exponential growth that everyone else had. And that was always my concern around GameStop, that the theme would end very quickly and a lot of people actually lose money, way more than those who gained money trading the thesis. And if you watch the movie, you kind of get the sense that there were winners and losers. It wasn't just, hey, the dumb money wins and everyone does well. The collective buying strategy does work, I think, as long as a stock is at least close to its fair value. Once it does what GameStop does, you're really in this sort of ether phase where you rely on all the other holders around you sticking to the cause. And to the credit of the GameStop saga and the Roaring Kitty followers, they kind of did that for a long time. And it was backed by himself holding the stock way past anything that was rational. I mean, he started with, in theory, a $50,000 bet. It got all the way to sort of $50 million as an investment, and he still held. And I think that held a lot of people in check during this story. Okay, the other thing that people don't realize is GameStop wasn't the only stock that was sort of being pumped up based on this meme stock story. AMC, the guys who make cinemas, like a Ster-Kinekor equivalent in South Africa, Bed Bath & Beyond was also struggling a lot back then. Nokia, even BlackBerry were getting bought as part of this meme stock saga. So they're in a number of different ways, these sort of dumb money investors trying to take advantage of the shorting that hedge funds did. And it has created a sort of story around don't ignore the dumb money when it comes to stories, especially around shorting, which is so risky and so dangerous. So again, watch the movie. I think it's a great movie. It's done really, really well. Hopefully in this episode, you've gotten a sense of what a hedge fund manager is. It needs to be said what a hedge fund manager is, because a lot of people don't really know what they're talking about when they say hedge fund. In exactly the same way people don't understand shorting. And the two go together hand in hand. It links to leverage and links to the risk inside hedge funds. And hopefully you now understand what a short squeeze is, which is actually quite an important topic around hedge funds, just like shorting is. The movie itself, again, speaks to this time in investing that was extremely weird. I said I would mention why. Effectively, we were sitting at home, we were bored, we had stimulus checks, which means we had money coming in. One big reason that many people miss is that sort of gambling kind of stopped because sports stopped. And gambling it's an important industry. It's a industry that gets a lot of traffic. So you had a lot of people who couldn't sort of access avenues like gambling, who had stimulus checks in their pocket, start to sort of invest in the stock market to replace gambling. And the stock market can almost be like gambling sometimes. So you had this sort of confluence of things come together that resulted in the GameStop saga. Will we ever see it again? Maybe. The internet creates places like Reddit where you can invest collectively. But like I said, because eventually you are going to sell the stock, it's not always going to work. There are going to be people left holding the bag in every single example of this, which is why it can't work into perpetuity. You have to sort of work as a collective, and that's very hard to do when people have their own objectives or their own goals. The last thing, which I think is again ignored by the movie but is important, I will get into it when we talk about sort of issuing stock and things. Did GameStop actually benefit from their stock price increasing? Now, the answer you think is probably yes, but no, not really. The way stock issuance works is you come into the market, you issue stock on day one. You bring in a bunch of cash for issuing stock, which is the reason why you issue stock in the first place. You need cash to do whatever, international expansion, buy factories, whatever it may be. Okay, those shareholders will then benefit from the share price increasing, not you. You as a company will only benefit from share prices increasing if you sell more stock. So let's say you sold GameStop stock initially for $100. Okay, you brought in a bunch of cash because you had multiple $100 based on all the shares you were printing. The only way you could benefit from GameStop stock increasing is by issuing more stock later down the line, which is what companies can do. They have that prerogative. GameStop didn't issue more stock, not that I know of at least. And that's because it was a precarious time for the company. There was a lot going on in the background. So as much as investors, especially the dumb money investors, benefited from the rise in GameStop, the company itself didn't really, which is an interesting little side note on everything. Okay, that's in and out 30 minutes on the GameStop story, the Reddit story, the dumb money movie. If you paused me up front to go and watch the movie, great. Hopefully this makes sense. If you didn't, I'm glad you listened to the episode. Go ahead and watch the movie. It's a good enough movie, made very well, that even if you're not that interested in finance movies, it is worth the watch. The people that I have surveyed really did enjoy it. So yeah, go and do that. My first movie recommendation. Maybe not my last. I don't know. We'll see how it goes. If you made it this far, as always, thank you so much for joining me. I hope you enjoyed the episode. You can find this on YouTube. You can find this on the podcast channels. If you want a different and alternative way of watching or listening compared to whatever you're doing now, you can also find us on socials, TikTok account, Instagram account, where you can sort of reach out to us via DM, via comments on things. We post some content during the week of the episodes, giving out sort of different ideas, different thoughts. So if you want to sort of join the community and interact with us, more than welcome. I'm happy to answer questions and things which I have done in the past. Also, if you're keen, like, subscribe, comment, depending on the platform you are listening or watching on. And if you do, we appreciate that also. But thanks for joining us. Another podcast episode. We will see you next time. Thank you and goodbye.